Hey guys, welcome back to my channel. So today we're gonna solve test 9 cost of capital chapter financial management. So the first question is the capital structure of Shine Limited has on 31st 3 2024 is as under. So this is as on 31st 3 2024. So then they have given the particulars such as equity share capital, preference, retained earnings, convertible debentures, term loan, and the total amount. Total it is 2 crore. And next they have given additional information. Company issued 13% convertible debentures of rupees 100 each on 1/4/2023. So it was issued on 1/4/2023, and then with a maturity period of 6 years. So the maturity period is 6 years. Then at maturity, the debenture holders will have an option to convert the debentures into equity shares of the company in the ratio of 2:1, and then 4 shares for each debenture. Then the market price of equity share is 25 each as on 31st 3 2024. So the market price of the share is 25 each as on 31st 3 2024, and the growth rate of the share is 6% per annum. So the debenture is redeemable after 6 years, and the market price of equity shares has on 31st 3 2024 it is how much? 25, and the growth rate per annum is 6%. And then they have given preference stock redeemable after 8 years is currently selling at 150 per share, and prevailing the prevailing default risk free interest rate on 10 years Government of India Treasury bond is 6%. The average market risk premium is 8%, that is RM minus RF is 8%, and beta values have given 1.54. Corporate tax rate is 25%, and the rate of personal income tax is 20%. It is required while calculating retained earnings, and then you are required to calculate the cost of equity share capital, preference share capital, convertible, retained, and term loan. So let's solve this question. So first we're going to calculate equity share capital value, that is KE, by using which formula? By using capital asset pricing model. Okay, so for that, risk free rate of return plus beta into RM minus RF. So here they have given that what RF, that is risk free rate of return, it is how much? The prevailing default risk-free interest rate on 10-year Government of India Treasury bond is 6%. So this is 6%, 0.06, plus they have given the beta value as 1.54. So 1.54 into, they have given average market risk premium is 8%. That is RM minus RF is market risk premium rate, that is 8%. So it comes out to be 1.54 into 0.08 plus 0.06. It is 0.1832. So KE is 0.1832. And next what we need to calculate? Then next we need to calculate preference share capital. So next second we're going to calculate what? Cost of preference share capital. So for cost of preference share capital, they have given that dividend plus redemption value minus net proceeds upon n all divided by redemption value plus net proceeds upon 2. So what they have given? They have given that dividend, it is 15% preference share capital of 100 each. So the dividend is 15 plus redemption value. Redeemable after 8 years is currently selling at 150 per share. So they have given nothing. So we're going to take redemption value as 100 minus net proceeds. They are selling the preference shares now at rupees 150 per share. So the redeemable value is 150 itself. Sorry, the net proceeds is 150 upon redeemable after 8 years. So 8 whole divided by again 100 plus 150 upon 2. So this comes out to be 0.07. And next, third question they have given is calculate the cost of convertible debenture. So convertible debenture, what they have given? They have given company issued 13% convertible debentures of 100 each on 1/4/2023. So they have issued it on 1/4/2023 with a maturity period of 6 years. So on 1/4/2023 it is 6 years. But now where we are at 2024. So from now till whatever the years is left. So if for 2023 it is 6 years, from 2024 the left number of years is 5. So n is equal to 5 years, not 6 years. Okay, this is a mistake most of us gonna do, but please avoid it. And next, what I have given? Okay, so to find KD interest into 1 minus tax plus redemption value minus proceeds upon n divided by redemption value plus net proceeds upon 2. So next, they have given that the debenture holders will have an option to convert debentures into equity shares of the company in the ratio of 1:4. So what is the redemption value? It is value of equity shares into 4 shares, okay, and the market price of equity shares. So now we're going to calculate what is the redemption value of equity shares. So for that, so the redemption value going to be market price of equity shares as of 2024 is 25. So 25 on 2024 it is 25. So after 5 years, what is the value of it is 1 plus growth upon whole to the power 5. So because the growth rate here given is 6%, so 25 into 1 plus 0.06 to the power 5. So 1.06 into 2, 3, 4, 5. So for 5 years into 25. So the price of the share after 5 years it's going to be 33.46. So 33.46. But here they have mentioned that 4 shares for each debenture. So for one debenture, so for one debenture they are getting 4 shares. So into 4. $33.46 into 4. So this is 133.84. So the redemption value gonna be 133.84. So what they have given? It is given 13% convertible debenture. So 13 into 1 minus tax. Corporate tax rate is 25%. So 0.25 plus redemption value. It is 133.84 minus net proceeds. Has they given anything? Maturity? No. So net proceeds, we're going to take it as 100 upon how many years left? They have issued it on 2024, but we are calculating it on 2020. Sorry, they have issued on 2023. We are calculating on 2024. So n is 5 years. So 5 whole divided by 133.84 plus 100 upon 2. So this comes out to be how much? So the total it comes out to be 0.1412, that is 14%. Fine. So the next question is retained earnings. It is very easy. So what is retained earnings? KE of retained earnings, it is KE into 1 minus personal tax. So it is given in the question. Personal income tax is 20%, and we have already calculated KE as 0.1832. So it is 0.1832 upon 1 minus 0.2. So this comes out to be 0.14656. And lost is for term loan. So for term loan we don't have redemption, net proceeds, this that, it is just interest into 1 minus tax. So this is what is the term loan interest. They have given that for term loan it is 11%. So 0.11 into 1 minus tax rate. So tax rate is 25%. So 0.25. So this is 0.11 into 0.75. So this is 0.0825. The second question, they have given that Toyota Limited has following capital structure as on 31st December 2023, which is considered to be optimum. That is 12% debentures, preference, equity share capital, and then the company share has a current market price of 30.25 per share, and the expected dividend per share in next year is 50% of EPS of 2023. So 2023's 50% gonna be, or EPS 50% gonna be the dividend, okay, of next year, because it is expected dividend. And they have given that the EPS of last 10 years is as follows. The past trend are expected to continue. So whatever the growth from this year to this year, this year to this year, this gonna continue. This is what they have told. And then the company can issue 14% new debentures and 12% new preference shares. The company's debenture is currently selling at 99. So this is the net proceeds. And then the new preference issue can be sold at a net price of 9.90, paying a dividend of 1.25 per share. The company's marginal tax rate is 50%. And then calculate after tax cost of new debts, new preferential capital, and of ordinary equity, assuming new equity comes from retained earnings. And then calculate marginal cost of capital for new funds raised, and how much can be spent for capital investment before new ordinary shares must be sold. And marginal cost of capital remains to be constant, assuming that retained earnings available for next year's investment is 50% of 2023's earnings. And what will be the marginal cost of capital, that is cost of funds raised in excess of amount calculated in part 3, if the company can sell new ordinary shares of 20. What will be the marginal cost of capital if company can sell new ordinary shares of rupees 22 per share, assuming both the cost of debt and preference share to be constant. So in the first question, we need to calculate after tax cost of new debts, new preference shares, and of ordinary equity, assuming new equity comes from retained earnings. So we need to calculate KD, KP, and KE. So what is KE? KE is D1 upon P0 plus G, right? So what is D1? D1, they have given that 50 expected dividend is 50% of 2023's EPS. So 2023's EPS is 3.023. So 50% of it is 1.5115. Right? Then we're going to calculate growth. So what is growth rate? We're going to calculate that using the formula future value is equal to present value into 1 plus growth rate. Okay. So now see, after 9 years from 2014 to 2023, EPS has been gone from 1.180 to 3.023, right? So assume now we are at 2014. So what is the price of EPS at 2014? It is 1.180. So this is the present value. And after 9 years, so 2014 to 2015, first year, second year, third year, fourth, fifth, sixth, 7, 8, 9, and after 9 years it has become 3.023, right? So 1 plus g to the power 9, and what is the future value? It is 3.023. So 3.023. So now by solving this formula, what we're gonna get is, so now let's solve this. So 2.56, and it still continues. Sorry. So So 3.25186. 12 times 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 minus 1 and whole to the power 1 upon 9, right? So what is this number? It is 9. So divided by 9 plus 1 and into equal to 12 times. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So we're gonna get 1.110. So 1 plus G is equal to 1.110. So G is equal to 1.110 minus 1. So it is 0.110, which means growth is 11%. Okay. So growth is 11%. So D1 1.5115 upon 0.11 plus this P0 is, they have given that what, yeah, it is 30.25. so it is 30.25. so 1.5115 divided by 30.25 plus 0.11. so this is 15.9%. so which is 16%. so it is rounded off to 16%. so the KE comes out to be 16%. and next we're gonna calculate. So what is cost of preference shares? So cost of preference shares is, they have given that dividend is 1.25 per share. So 1.25 upon P0 is, they have given that the new preference issue can be sold at a net price of 9.90. so upon 9.90, so this comes out to be 1.25 divided by 9.90. it is 12.63%. and so now we have calculated KP and KE. Now we have to calculate only KD. Okay. So for KD, what they have given, they didn't mention number of years, this that. So the formula going to be simple. It is just interest into 1 minus tax upon net proceeds. So what is interest? They have given that 14% new debentures. So 14 into tax rate, it is 50%. So 1 minus 0.5 upon net proceeds. They have given that the company debentures is currently selling at 99. So divided by 99. So 14 into 0.5 divided by 99. So the KD is 0.070707, or it can be 7.070707%. Okay. So we are done with the first question. And the second question is, calculate the marginal cost of capital for the new funds raised. So guys, not to make this video very too long, so I'm just explaining over here. So here all this debentures, preference and equity and amount has given before. So when you're gonna calculate the weight based on this amount, this is going to be the weight. So while calculating the marginal cost of capital, only the one thing changes when compared to WCC and marginal cost of capital is only the CI. Okay, because we don't know what is the total amount raised or something. Only we know this percent of interest is paid for this debentures, and this is the market value, that is the market value, and this that's all. So only CI gonna change. So because of CI, WCI changes. Okay, so here CI, as we calculated before, that is cost of capital of respective debentures, preference and equity, as we calculated, it is 7.07, 12.6 and 16. So when you calculate both of this, the total marginal cost of capital going to be 14.492. okay. And then what is the third question? We are done with first and second. And how much can be spent for capital investment before new ordinary shares must be sold, and marginal cost of capital remains to be constant. So it's going to be 14.492 itself, assuming that retained earnings available for next year's investment is 50% of 2023's earning. So what is 50% of 2023's earning? So 2023's EPS is 3.023, right? So retained earnings is 50% of 2023's EPS, that is 3.023 into how many shares are there? They have given that 2 lakh shares, right? So into 2 lakh. So this is going to be 3.023 into 2 lakh into 50%. So this comes out to be 3 lakh 2,300. Okay, so this is for 80%, and they have mentioned that the marginal cost of capital gonna remain to be constant. Okay, so this is for how much this, so equity consists of retained earnings. So this is for 80%. So for 80%, this much of retained earnings we have. So for 80%, if this is the total capital investment, for 100% how much? So we're going to calculate divided by 0.8. So for 100%, it is, for the total capital investment, we have retained earnings of 300 at 80%, but for 100% it is 3,77,875, but we have only amount of 30 to 300. Okay, so what is the amount left? So 30 to 300, so we still need 75,575. So from where we can raise this? So we can raise this amount from new debentures and new preference share as mentioned in the question. So that is, they have given that the company can issue 14% new debentures and also new preference shares. So how we gonna issue it? On the basis of weights. So that is, for debentures we have already mentioned that it is 0.15, and for preference it is 0.05, means in the ratio of 3:1. 5 ones are 5 threes are. Okay, so 3:5. In the ratio of 3:1, we can issue this debentures and preference shares. Okay, so we still need this 75,575, and this we're gonna raise from debentures and preference in the ratio of 3:1. I hope you are clear with this question. And then what they have given, what will be the marginal cost of capital, that is cost of fund raised in excess of amount calculated in part 3 if the company can sell new ordinary shares of 22 per share, assuming both the cost of debt and preference share capital to be constant. So now KE gonna change, means from KE we gonna calculate CI. Okay, so CI of KE, and then except that rest of the things gonna remain same. So what is KE? They have given that if the company can sell new ordinary shares of 22 per share. So if the P0 is 22, then what is KE? So what is dividend? Dividend we have already calculated, that is 3.023 into 50%. So 3.023 into 50%. So this is 1.5115, and P0 is 22. Only this thing gonna change. Plus growth we have already calculated it as 11%. So 0.11. So this comes out to be divided by 22 plus 0.11. So this is 0.1787 or 17.87%. So 17.87%. Okay, so rest of the, in marginal, now we have to calculate what will be the marginal cost of capital. So in marginal cost of capital, always the weight gonna remain same, and CA also remains same, because only for KE they told the price of the or new ordinary share is going to change. So it is 17.87. So now if you multiply this, we're going to get the answer. So it is 17.87 into 0.8. So this is 14.296, and then 12.63 into 0.05. So 0.6315, and then 7.07 into 0.15. So 1.0605. So total gonna be 15.988%. So this is gonna Ram Limited evaluates all its capital project using discounting rate of 16%. Means over here, what is 16%? It is WACC, that is weighted average cost of capital, because they have given that all its capital projects using discounting rate. What is the discounting rate? It is 16%. Okay, and then they have mentioned that Its capital structure consists of equity share capital, retained earnings, bank term loan, debentures redeemable at par, redeemable par, and then rate of interest on bank term loan is 1.4 times that of debentures, and then remaining tenure of debentures and bank loan is 4 years and 6 years respectively. Then they have given that book value of equity retained and bank loan is 20 lakh, 30 lakh and 20 lakh respectively. Debentures which are having book value of 30 lakh are currently trading at 98 per debenture, and the ongoing PE multiple for the shares of the company stands at 4. Then we need to calculate rate of interest on bank loan and rate of interest on debentures. So tax applicable is 30%. So let's solve. So guys, in this question they have given all this information. WACC, they have given that weighted average cost of capital as 16%, and then they have given that rate of interest on bank term loan is 1.4 times that of debenture, that is interest rate of debenture into 1.4, and then they have given remaining tenure of debentures and bank loan, that is 4 and 6, and then they have also given the book value of everything. We have written here, we have combined equity, that is equity share capital plus retained earnings 20 plus 30 as 50 lakh, and then bank loan 20 lakh, and then debentures 30 lakh, and then we have the ongoing debentures which are having a book value of 30 lakh or currently trading at 98 per debenture. So it is net proceeds, and then the ongoing PE multiple of the shares of the company stands at 4. So PE we have 4, and now we are required to calculate the rate of interest on bank loan and calculate the rate of interest on debentures, and tax applicable is 30%. Fine. So using all this information, now let's solve this question. Okay. So if what is PE? PE is equal to MPS upon EPS, as well as we have one more formula for PE, that is PE is equal to 1 upon KE, right? So from this we're going to calculate the cost of equity. So what is cost of equity? So cost of equity is now KE upon PE. So 1 divided by 4, it is 0.25. Okay. So from this we got KE is equal to 0.25. Done with this. And next we have bank loan. So in this it is very important to remember that for cost of debentures and cost of bank loan, the formula is always, see, for debentures we just gonna take interest into 1 minus tax. So what is interest? If they have given 13%, then 100 into 13. So 100 into 13%, so it's gonna be 13. But for cost of while finding out for bank loan or term loan or whatever, we don't gonna take interest, but we just gonna take interest rate, which means if they have given 13%, then you don't gonna do 100 into 0.13. we just gonna take 0.13, that is whatever the interest rate, just take the interest rate, not into 100. Okay. So now let's move further, and yeah, interest rate, what, we don't know the interest rate, so assume interest rate as X. Okay. So assuming interest rate as X, so now what is the value of debentures? It is 100. So 100 into X percent, whatever the percent we don't know, so 100 into X into 1 minus tax, that is tax is 30%, plus redeemable value is 100, because they have given nothing, so assume it as 100, or they have given okay, maybe they have given yeah, they have given that debentures are redeemable at par, so it is 100 minus net proceeds. They have given that they are trading at 98 per debentures, so 98 upon what is the remaining life for debentures? It is 4. So 4 whole divided by 100 plus 98 upon 2. So this comes out to be, so by solving this equation, we're going to get it as 70x plus 0.5 upon 99. Okay. So what is the cost of debentures? It is 70x plus 0.5 upon 99. Okay, and then for cost of bank loan, it is interest rate, never ever interest. Okay, so interest rate, what is interest rate? We just took it as x. So x into 1 minus tax, so that is 0.3, but they have mentioned it as into 1.4 times, so this comes out to be 0.7x into 1.4, so this is 0.98x. okay, so 0.98x. So for bank loan it is 0.98x, and then we're going to multiply this with this, this with this, and this with this. Okay. So 0.98 into 0.2 comes out to be 0.19x, 0.196x, and 0.5 into 0.25, it is 0.125, and then this 0.3 into 70x plus 0.5 upon 99. So now we're gonna add all this is so this 3 is equal to 16%. So by solving this, we're gonna get the answer of interest rate. Okay, not interest, interest rate. So it is 0.125 plus 0.196x plus 0.3 into 70x plus 0.5 upon 99 is equal to 0.16, that is 16%. So shall multiply both sides with 99. So 99 into 0.125, 12.375, 0.196, this comes out to be 19.404x, plus we are left with 0.3 into 70x plus 0.5 is equal to 0.16 into 99. This is 15.84. So 15.84 minus 12.375, 3.465, and then 19.404x plus 0.3 into 70, 21x, 0.5 into 0.3, 0.15. So 21 plus 19.404, so this is 40.404x is equal to this minus, so this is going to be 3.450. So 3.450 upon 40.404, so x is equal to 8.538%. So for interest on what, so rate of interest on debentures is 8.538%, and for bank loan it is 0.08538 into 1.4, sorry, into 0.98. So this comes out to be 0.0836, which means approximately 8.36% or 8%. So this is going to be the answer. So sorry guys, here I've done a little mistake, so I should trust my calcium more than myself. So I'm really so sorry for this. So the answer is not this or this, but the answer is 8.20 and 11.48. Why everything is right, but a silly mistake happened over here is, here I have taken 3.465 minus 0.15 as 3.450, but this is a wrong answer. It is 3.465 minus 0.15 is 3.315, but I have taken here as 3.450, so my mistake. I'm really so sorry for this. So 3.315 upon 40.404, so this comes out to be 8.20, same as given in the answer, right? So sorry for this silly mistake. So the answer is 8.20. And so next for bank loan, again this got wrong because of the above answer. So it is 1.4 times of x. So here x is 8.2%. So 8.2 into 1.4. So this comes out to be 0.1148, which means 11.48. So sorry for this silly mistake. So this is 11.48% is the KD of bank loan, same as given in the solution. Calculate WACC using the following data by using market value weights. Okay, we need to calculate weighted average cost of capital by using market value weight. Okay, so equity, reserves, preference, debentures, book value. So all the stuffs are related to book value. And then we have market price of securities. So what is market price of securities? From this we need to calculate WACC. So market price of debentures 105, preference 115, equity 27 per equity share. And then additional information. So 100 face value per debenture redeemable at a premium of 10% and 10% coupon rate, means 10% is the interest rate, and then 4% flotation cost. Flotation cost is on market price. Okay, so 4% flotation cost and 10 years maturity. Then 100 face value per preference share redeemable at par, and then 12% coupon rate, that is 12% preference shares, and then 2% flotation cost, again 2% is on market price, and 10-year maturity. And equity share have 4.5 flotation cost. They have given the amount, so you don't have to calculate anything. So market price is 27 per share. The last paid dividend by the company was 2. So D0 is equal to 2, and which is expected to grow at an annual growth rate of 9%. So G is equal to 9%, and firm has a practice of paying all earnings as dividend. The corporate tax rate is 25%. And then calculate overall cost of debt, preference share, and take the average of their respective cost using YTM and approximation method. So by using YTM we're going to calculate the cost of debt and preference shares. Okay, so guys, what they have asked in this question, so they said that take the average of the respective cost using YTM and approximation method, and it is only for debt and preference share. So what is left? It is equity we're going to calculate normally, but only for debt, means for KD and KP we're going to use both the method, and we're going to take the average of it. So first let's solve by using YTM, that is yield to maturity approach. Okay, so from that what is the net proceeds over here for KP, that is cost of preference shares? The net proceeds is, they have given that 2% flotation cost and the market value is 115 per share, right? So 115 minus 2%, so this comes out to be 11.2.7. so net proceeds is 11.2.7. so first 0 year and 1 to 10 years, then at the 10th year what is the redeemable value, that we're going to write. Okay, so first year like when you make an investment you have to invest how much? 11.2.7. so this is an outflow first year, and from first year up to 10th year what is the interest on preference share we're gonna get? It is 12% coupon rate, means 12% into 100 face value, so we're gonna get 12 rupees as a dividend. And in the 10th year they are redeemable at par, so it is 100. Fine. Then now we're gonna take any 2%, and from that we're gonna calculate the net present value. Okay, so now the let the discounting factor be 5%. So in the 0 year it's gonna be 1, and up to 1 to 10th year it's gonna be 1 divided by, so 1 plus 5%, so 1.05. okay, so 1 divided by 1.05. First year, second year, third, fourth, 5, 6, 7, 8, 9, 10. So the value is in the 10th year it is 6.6139. So what's the value in the 10th year? It is 1 divided by 1.05. Yeah, it is this itself. So in the 10th year the discounting factor is 0.6139. and what is the total of all this 10 years? So after calculating up to 10th year, what we're gonna do, just after calculating all this, just press GT, then the total value comes out to be 7.7217. so 7.7217. So what is the net present value? So 7.7217 into 12. So this comes out to be 92.6604, and 100 into 0.6139 comes out to be 61.39, and then minus, so 112.7. So 92.6604 plus 61.39 minus 112.7, so 41.3504 net present value from low discounting factor. And then for 10 it is 1 divided by 1.1. so this again for 10 years, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So the answer is 0.3855. The discounting factor at the 10th year is 0.3855, and then just click GT to know the total value. So this is 6.1445 or 6.1446, 6.1446, and then yeah, for 0 year the value going to be 1, and if now 1112.7 and 6.1446 into 12. So this comes out to be 73.7352 and 0.3855 into 100. So this is 38.5. 38.55 plus 38.55 plus 73.7352 minus 112.7. So this is going to be minus 0.4148. So lower rate it is 5%, so 0.05 plus net present value at lower rate it is 41.3504 upon net present value at lower rate minus net present value at higher rate. So what is this? So this is going to be 41.3504 minus higher rate, right? So minus of minus plus, so it's going to be plus 0.4148. So this is going to be 41.7652. 41.7652 into higher rate minus lower rate. So this is 10 minus 5. So again it is 5%. So this comes out to be by equal to 41.3504. So 0.99900 into 5%, so 0.05 plus lower rate again 5%. So the answer is 0.0995. So 0.09950. So 9.9503%. This is the KP from YTM approach. Okay. Now let's solve KD from YTM approach again. So again it is years 0, 1 to 10 and 10, and cash flow in the first year is net proceeds. So what is the net proceeds? They have given that debentures 105 per share. So 105 minus, they have given that 4% is the flotation cost. So 105 minus 4%, this comes out to be 100.8. So the net proceeds is 100.8. So first year outflow going to be 100.8. And from first year up to 10th year, what is the interest rate we're going to get on debentures? It is 10% coupon rate. So 10. And in the 10th year, debentures, remember that premium of 10%. So 1, 1, 10. Okay. And same we have calculated above. It is 1, 7.7217, 0.6139, and same again for 10% 1, 6.1446 and 0.3855. So what is the net present value? So 100.8 and then 10 into this. So 10 into 7.7217. So it is 77. Yeah, 77.217 and 61.446, and then 110 into 0.6139. So this comes out to be 67.529. So 67.529, and then again 110 into 0.3855. So 0.3855, this comes out to be 42.405. So 42.405 plus 61.446 minus 100.8. So this is 3.051, and then 67.529 plus 77.217 minus 100.8. So this is 43.946. So 1 second. So guys, why I wasn't getting negative NPV was because here I forgot to deduct interest rate. So interest into 1 minus tax. So this is 10 into 1 minus 0.25. So this is 10 into 0.75. So this comes out to be 7.5, but I took as 10. So this is where I got wrong. So 7.5 into 7.7217. So this comes out to be 57.91275. So this is 57.9127, and 7.5 into 6.1446. This comes out to be 46.085. So 46.0845. So net present value going to be 42.405 minus 100.8. So yeah, now I got a negative NPV. So that is minus 12.3105 and here it is 57.9127 plus 57.9127 plus 67.529 minus 100.8. So this is 24.6417. So now I got both positive and negative NPV. So from this, YTM going to be again lower rate, that is 0.055%, and lower rate plus NPV from lower rate, that is 24.6417 upon lower NPV from lower rate minus NPV from higher rate. So that is 24.6417 minus, so minus of minus it becomes plus 12.3105. So this comes out to be 36.9522. So 36.9522, and higher rate minus lower rate, so that is 10% minus 5%, again 0.05. So divided by equal to 24.6417 into 0.05 plus 0.05. So this comes out to be 0.0833 or 8.3342%. So this is KD from YTM approach. So in question what they have mentioned, we have to take the average of KD and KP from both the method, that is from YTM and approximation method. So from approximation method, let's find out the value. So from approximation method, we're going to use this formula. So what is KP? That is for dividend plus redemption value minus net proceeds upon n, all divided by redemption value plus net proceeds upon 2, right? So they have given that dividend is 12% coupon rate. So 12 plus 100 minus 11.2.7, that is what is the market value? 115 minus 2% flotation cost. So this comes out to be 2.7 upon 10-year maturity. So 10. So again same redemption value plus this upon this. So we're going to get the answer as 10.089. Okay. This is from approximation method. And from YTM we got KP has 9.95%. So what they have given, take the average of the respective cost using both YTM and approximation. So 9.95 plus 10.089 upon 2. So from this we're gonna get 9.95 plus 10.089 divided by 2. So the average is going to be 10.0195%. Okay. And for KD, again KD is interest into 1 minus tax upon, interest into 1 minus tax plus redemption value minus net proceeds upon n, whole divided by redemption value plus net proceeds divided by 2, right? So what is the interest rate? They have given that 10%. So 10 into 1 minus tax, that is 25%. So 1 minus 0.25 plus redemption value, they have given that redeemable at a premium of 10%, right? So 110 minus 108, that is 105 minus 4% flotation cost. So 100.8 all divided by 10-year maturity. So 10 whole divided by 110 plus 100.8 all divided by 2. So we're going to get the answer from approximation method. KD is 0.799. So 7.99% plus from YTM method we have already calculated it as 8.33%, right? So average, so divided by 2. So 7.99 plus 8.33 whole divided by 2. So this comes out to be 8.16%. Okay. And we are left with equity. Equity is 27 per share. So 27 minus they have given that equity shares have 4.5 flotation cost. So minus 4.5 upon dividend. They have given that last dividend paid by the company is 2. So D02 plus growth. Annual growth rate is 9%. So plus 9%. If they have given D1, then we don't gonna add the growth. But if it is D0, so D0 plus growth. Okay. Next plus G. So again 9%. So this comes out to be plus 9%, 2.18. So 2.18 and 27 minus 4.5, it is 22.5 plus 9%. So divided by 22.5 plus 9%. So 18.688888. So this is KE is equal to 18.69%. Okay. So now we have got KP, KD and KE. Okay. So for KE it is 18.69, but for KD and KP we are going to take the average percent, that is 8.16 and 10.0195. Fine. So from using this value and market value, we have to calculate WACC. Fine. So WACC is equal to equity. Equity is 20. Now according to market price, it is 27 per equity share, right? So how many equity shares we have? We have 1,50,000. Why 15 lakh divided by 10? So 1,50,000 equity shares. But the book value is 10, but the market value is 27 per equity share. So 1,50,000 into 27. So it comes out to be 40,50,000. Okay. So amount is 40,50,000. And then for debentures, 100 per debenture. So 5,50,000. Yeah, where is the debenture? Yeah, 5,50,000 divided by 100. So this is 5,500 debentures into what is the market value of debentures right now? It is 105. So into 105. So this comes out to be 5,77,500. And then for preference share, it is 100 per preference share. So 7,50,000 divided by 100. So 7,500 preference shares into market price 115. So this comes out to be 8,62,500. So 8,62,500. So 8,62,500 plus 5,77,500 plus 40,50,000. So this comes out to be 54,90,000 divided by equal to 40,50,000. So the weight is 0.7377 and 5775 divided by 5490. So this comes out to be 0.1052 and 862,500 divided by 5490. So 0.1571. So the total has to be 1, right? So 0.1052 plus 0.7377. So the total is 1. Okay. And then CI, we have already calculated it. So what is CI for KE? It is 18.69. So for equity it is 0.1869. And for debentures, from average we have calculated KD as 0.0816. And for preference it is 10%. So 0.10019. So now multiply both of this. So 0.7377 into 0.1869. So 0.1379 and 0.0816 into 0.1052. So this is 0.0816 into 0.1052. Yeah, 0.0085 and 0.10019 into 0.1571, 0.01573 plus 0.0085 plus 0.1379. So this comes out to be 0.1621398. So this is going to be WACC. So we are done with this question. Thank you. So in fifth question, they are given that BS Limited has following capital structure. at book value as on 31st March 2024, and equity share capital preference debentures they have given, and the total is 4 crore 60 lakh, and the equity shares of the company are sold for 300, and then it is expected that the company will pay next year a dividend of 15 per equity share, which is expected to grow by 5% per annum forever. Assume 35% is the corporate tax rate, and then compute weighted average cost of capital of the company based on existing capital structure. So based on this capital structure, and then compute the new WACC if the company raises additional 50 lakh debt by issuing 10 years 12% debentures, but the yield on debentures of similar maturity and risk class is 13%. So yeah, we are issuing 12%, but for similar debenture it is 13% interest rate. So the flotation cost is 2% and face value of debenture is 100. This would result in increasing the expected dividend to 20. So first the dividend was 15, but now it is expected to increase to 20. Leave the growth rate unchanged, so it is 5% itself, but the price of equity share will fall to 250 per share. Before it was 300, now it will fall to 250 per share. So we need to calculate WACC for the existing capital structure and for the new capital structure. So guys, this is going to be, first we're going to just calculate weighted average cost of capital based on the existing thing, right? So for this KP, that is they have given that 11.5% preference shares. So KP is 11.5% itself, and then we're going to calculate KD. How? Interest into 1 minus tax upon net proceeds, because there is no redemption value or number of years is that. So simple formula this one. So what is interest? They have given that 10% debentures, right? So 10% debenture in the sense 100 into 10%. Tax rate it is given how much? 35%. So 1 minus 0.35 upon 100. So it comes out to be 0.065 or 6.5%. And then KE. KE is they have given that the equity shares of the company are sold at 300. So what is the price? 300 P0, and it is expected that the company will pay next year a dividend. So next year dividend in the sense it is D1, right? So 15 is 15 per equity share. So this is D1 plus G 5% per annum forever. So 0.05. So this comes out to be 15 divided by 300 plus 0.05. So 10%, okay, 0.1 or 10%. So what is the weight? So 3 divided by 4.6. This comes out to be 0.652 and 0.6 divided by 4.6. So this comes out to be 0.1304, and next 1 divided by 4.6. So this comes out to be 0.217. So 0.217 plus 0.1304 plus 0.652. So 0.99999 means 1. Okay. So cost we have already calculated that. For preference shares it is 11.5%. So 0.115, and for debentures it is 0.065. So 0.065, and for equity it is 10%, that is 0.1. So this into this. So 0.652 into 0.1, 0.0652 and 0.115 into 0.1304, 0.01499 and 0.065 into 0.217. So 0.014105 plus 0.01499 plus 0.0652. So the total going to be 0.094295, or you can also say 9.4295%. Okay, so this is WACC for first, but for second we need to calculate. So for the second one it is what they have given? They have given that compute new WACC if the company raises an additional 50 lakh debt by issuing 10 years 12% debenture. So first, what is the value of debenture at which price we're gonna issue it? This one we need to calculate, okay? So 12% debenture, but the yield on debenture of similar maturity and risk class is 13%. Means if the debenture value is 100, for that they are paying how much interest they are paying in the market? They are paying 13% interest, but what we are paying? We are paying just 12% interest, okay? So at what price we need to give it to buyers so that they're gonna buy our debentures. So we are just providing 12% interest, but in the market for the same kind of debentures having similar maturity and risk class, they are providing 13% interest. So our issue price has to be, so just cross multiply, okay? So when you cross multiply, it is 0.12 into 100 divided by 0.13. So the value is 92.3076, okay? So 92.3076. So only if you issue at this price, people gonna buy, or else if the issue price is more than this, nobody gonna buy. So the discounted price has to be for debentures is 92.3076. Fine. I hope you are clear with this. And yeah, what they have mentioned, the flotation cost is 2%. So again we have flotation cost here. So 92.3076 minus 2%, it is on face value. So 100 into 2% is 2. So this comes out to be 90.3076, okay? So the net proceeds value is this. And then what is the redemption value? Has they given anything about it? No. Face value of the debenture is 100. This would result in increasing the expected equity dividend to okay. So nothing about this, only this much is the information. So what is KD? KD is interest into 1 minus tax plus redemption value minus net proceeds upon n whole divided by redemption value plus net proceeds upon 2, right? So what is interest? They are paying 12% interest. So 0.12 into 100 into 1 minus tax rate is 35%, so 0.35 plus redemption value is, they have given nothing, so assume it is 100 minus net proceeds, it is 90.3076 upon, for how many years they are issuing? They are issuing it for 10 years, so whole divided by 10 into 100 plus 90.3076 divided by 2. So this comes out to be 0.9021 or 9.21%, okay? The next we gonna calculate KE. So what is KE? KE here is KE is equal to D1 plus P0 plus G. They have given that it would result in increasing the expected equity dividend to 20. So expected equity in the sense, again it is D1, not D0, okay? Because we are expecting it for next year, right? Because of the issue of new debentures, now equity shareholders are expecting the dividend to be 20 rupees. So this is 20, okay? So 20 upon the growth rate constant. So this is going to be 5% itself upon P0, but the price of the equity share will fall to 250 per share. So P0 is 250. So this comes out to be 20 divided by 250 plus 0.05. So this is 0.13 or 13%, okay? So this is KE. So now we need to calculate WACC, new WACC, okay? So this is all old, capital structure which is already given the question, but for that we raised an additional 50 lakh, right? So this is already present 10% debenture, but the newly issued is of 12% debentures, so it is of value 50 lakh, okay? So the total comes out to be, it's already 4.6 6 crore. So 4.6 plus 0.5. So this is going to be 5.1 crore, 5 crore 10 lakh. Okay. So the weight going to be 3 divided by 5.1. So 0.588 and 0.6 divided by 5.1. So 0.118 and 1 divided by 5.1. 0.196 and 0.5 divided by 5.1. So this is 0.098. So that would have going to be 1. And we have already calculated the KD of new 12% debentures is 0.0921 and 10% debentures KD is this also we have already calculated. This is how much it is for old 10% debenture. The KD is 0.065. Okay, so 0.065 and for preferentials it is 11.5. So 0.115 and the equity it has been changed because of raising additional capital. So the new KE is 13%. So 0.13. So now let's calculate. So it's going to be 0.588 into 0.13, 0.07644 and 0.115 into 0.118. So this comes out to be 0.01357 and 0.065 into 0.196. So this comes out to be 0.01274 and 0.021 into 0.098. So it's going to be 0.0090. So this plus 0.01274 plus 0.01357 plus 0.7644. So the total going to be 0.1117 or 11.178%. Okay, so this is going to be the new WACC. So we are done with this. So thank you so much for watching. If you have any doubts, do let me know in the comment section. And thank you.